Welcome to the Investment Management Service update. So following a strong autumn period, November saw slightly more mixed returns and a slightly more volatile market. Against that backdrop, the JMFIN funds held up okay. The Conservative fund was down just 0.2%, all the way through to the Adventurous fund, which was down just 0.7%. So I'm here with John, who's going to talk us through what happened during the month. So John, why don't you give us a quick run through of what we're seeing in markets?
Yeah, so it was really all about the US Federal Reserve, the US Central Bank, releasing minutes from its October policy meeting, which read a little bit hawkishly around the upside risks to inflation. I remember the Fed is still quite divided in terms of the voting committee, so the market took that to mean that perhaps there was not such a high probability of a rate cut at this week's policy meeting. So probability fell to 25% before some dovish Fed speak pushed the probability all the way back up to about 80%, which is where we are today.
Yeah, and I think it was that swing that really allowed markets to kind of pull back in the second half of the month. But I think, whilst it was a challenging month, actually, if we look year to date, equity returns have still been really quite strong. And actually, when we think about both relative and absolute performance for the funds, we've benefited from the broadening out of returns, which has come through different geographies and different markets. Yeah. Now, you've spoken a little bit about America and American kind of politics, I guess, there. But actually, that was not the main focus, I guess, for UK investors during the month. Actually, if we look at the news cycle, clearly front and centre of most people's minds was the UK budget. So how did that kind of affect markets and how did that play out?
It's pretty mixed, really. 4 billion worth of fiscal headroom at the end of the period seemed pretty generous in comparison to what people were going for. But there was an additional 60 billion of borrowing in the first 2 to 3 years, which didn't land so well initially with the market. But the overall tax hike of 26 billion with extra spending of 8 billion getting to a surplus of 22 billion in 4 to 5 years' time seemed to go down okay with the market. But of course, this fiscal tightening that the markets are pricing in is backloaded. And clearly there's a risk around delivery going into an election.
Yeah, and I think where we were worried that maybe the budget might have an impact in markets was in the bond market. And actually the reaction was quite relaxed. But I think as we look further out, as you say, the fiscal tightening is quite back-end loaded. And so I think the risk remains of slightly higher yields in the long term and a slightly steeper yield curve. And against that backdrop, as we think about protecting the portfolio, I think we still try to focus on some of the shorter duration bonds and trying to manage the risk there. We normally talk about the outlook in these conversations. We're coming into the start of 2026. So it'd just be good to get your thoughts on how we're positioning portfolios and how we're thinking about markets through the next period.
Yeah, thanks, James. So corporate earnings delivery broadening out by region and sector, which I think will be a tailwind for markets in the round. We think that central banks outside of the Bank of Japan are going to be easy on the monetary policy, so that will support. And there's also some fiscal thrust coming out of the US and also, more importantly, out of Europe as well. So put it in the round, it does feel very much like more of the same.
Yeah, so we've seen in November, we've seen the defensive parts of the portfolio really start to protect returns as we hope they would. And we think that still does have a part to play. But I think actually as we look a little bit further out, we remain cautiously optimistic for 2026. And we still think that returns should be reasonably good into the medium term.